The top news story in Australia as we record this says, despite talk of inflation easing and price promotions, the receipts don't lie, with a major analysis showing soaring prices at Coles and Woolworths. Prices at the two stores combined went up 9.2% overall. That's according to UBS's Evidence Lab. And the version on my phone actually adds, more inflation to come, warn analysts. Jim Rickards has just written a new book called Sold Out: How Severed Supply and Surging Inflation Will End Consumer Choice. So I think it's fair to say, Jim, that you are not surprised by what's going on. But how do I explain our soaring grocery bill to my Japanese wife?
Well, the way to do it is, of course, we all know inflation means higher prices. So that's a basic definition. Don't need to spend a lot of time on that. But what's less well known is that inflation has several sources, several vectors, if you will, where it might come from. And to state the obvious, it can either come from the supply side or it can come from the demand side. Supply side inflation, price shocks, in other words, are called cost push inflation. Cost goes up and vendors push it onto the consumers. But the demand side inflation, which actually comes from consumers, is called demand pull. That means the consumers are pulling demand forward. They're in a rush to buy goods because they're worried that the price is going to go up. Now, in either case, or in both cases, you get higher prices. But the dynamics are very different, which is highly significant in terms of where we go next. So is inflation here? Absolutely. It's in Australia, it's in the United States, Europe. You see it all over the world, actually. Even Japan, which has suffered from deflation more often than not, is seeing inflation of about 4%. That may sound low to an American or an Australian, but that's sky high to the Japanese. So they're feeling the price shock as well. So it's real and it's here. But the difference is that when it comes to the supply side, which this does, higher energy prices, the supply chain breakdown, which I talk about in my book, Sold Out, how transportation costs went up, producer prices, the inputs went up. There's a shortage of drivers, backlogs at the ports. All these things add costs. If a truck has to wait, the chassis 4 days to pick up its container off a cargo vessel and deliver it to a distribution center, well, that's 4 days of waiting time, 4 days of fuel, driver costs, et cetera, all of which adds to the cost of goods. However, it tends to snuff itself out. Let me explain how that works. Sure, the price of petrol at the pump has doubled. It's come off a little bit and moderated a little bit in recent months, but at least in the United States, between June 2021 and June 2022, it doubled. Well, if you were paying, say, $75 to fill up your Ford F-150 truck, I dare say it's a little more in Australia because your taxes are higher, but a gallon. But just to give an example, if you were paying $75 to fill it up, and now you're paying $150, which is true in a lot of cases, well, you do it anyway. That's called inelastic demand. It means that you may not like the price, but you have no choice. You've got to go to work, take the kids to school, deliver goods, use your truck and your job, whatever it is. You have to do it. You have to pay that higher price. But it means that $75 extra at the pump, maybe twice a week, so $150 a week. That's $150 you don't have to spend on something else. Could be concert tickets, a show, dinner, a new dress, a new suit of clothes, whatever it might be. You're not going to buy that because you've just spent that much money on the gasoline. Well, that means all those other industries suffer. Retailers have lost sales, restaurants have empty tables, concerts have empty seats, and so forth across the entire spectrum of goods and services. Well, soon enough, that results in layoffs, some business failures, price cuts, et cetera. And that disinflationary and deflationary trend ends up in a recession. We saw this in 1974 when the world suffered the oil price shock because of the Arab-Israeli war. The war was actually in 1973, late in the year, but the Arabs imposed an oil embargo. Oil prices quadrupled over the course of the next year. Well, that was an inflation shock, a supply-side shock to be sure. But at least in the United States, 1974, toward the end of the year, was one of the worst recessions. In fact, at the time, it was the worst recession since the Great Depression. Now, we've managed to top that record a few times since then, but in 1974, it was the worst that we had seen since the Great Depression. And then it was kind of an embarrassment for policymakers because President Gerald Ford was the president of the United States at the time. Alan Greenspan was around. It seems like he's been around for half the century. He wasn't chairman of the Fed at the time, but he was in the Council of Economic Advisors. And they ginned up these buttons. It said WIN, the win buttons, and everyone was wearing them. The president was wearing one, and it said whip inflation now. Well, they whipped inflation. It came down fast in a matter of months. And it was kind of embarrassing, that whole campaign. But that's what a supply side shock does. When it comes from the demand side, wages going up too much, unions demanding more, one union wants more than the last union, et cetera, and the central bank accommodates that with money printing, then it changes consumer psychology. They say, well, I was thinking of getting a refrigerator or a new dishwasher or whatever, but I better buy it now because the price is going to go up. If I wait 3 months, it's going to go higher. I better buy it right now. That's demand pull inflation. That actually can feed on itself. The supply side type snuffs itself out because it destroys demand. The demand side tends to feed on itself because it's true. People bid up prices, and then it's really up to the central bank to step in and raise interest rates, which is what we saw in the United States in 1980 81 when they took interest rates to 20%. So it's please explain to your wife, and I hope all of our listeners get the fact that the inflation's real, no denying it. I always say you're entitled to your own opinions, but not to your own data, and the data makes the inflation clear. But you'll see a couple of things. And I'll speak to the United States, Australia. Not everything, these phenomena are worldwide, but they're not in complete synchronicity. Some countries hit it sooner than others for various reasons. But in the United States, the inflation has already started to come down. Now, it's still too high. Don't get me wrong. It's still too high. The Federal Reserve's target is 2%. Inflation, depending on the metric you use, is running around 6%. But it was 9 last June, and it was 8.7, 8.2, 7.5, and now it's down into the sixes. That's still high relative to the 2% target the Fed has, but it's coming down, and I expect it to come down even more sharply. I think Australia is a little bit behind that cycle. Their inflation kicked in a little bit later. It may last a little bit longer. And even on the downslope, it's still too high, and that's the point. And that's why the Reserve Bank of Australia soon will be looking at further rate increases, and the Federal Reserve is well on that path of rate hikes. So the important things are, number one, this is coming from a supply shock, not from the demand side. Consumers aren't feeling all that strong. Number two, this will tend to snuff itself out because the extra you spend on something means less spent on something else, and that tends to depress the economy. And what investors and consumers may not be ready for is a coming wave of disinflation. Disinflation, you still have inflation, but it's at lower rates. When it goes, 9, 8, 7, 6, down to 2 someday, you still have inflation. There's still positive numbers, but that's disinflation. It's coming down. If you cross the zero boundary and you get into negative price increases, basically price declines, that's deflation, and don't rule that out. So we've just kind of geared up for this inflationary mindset. It's real, but it's going to come down a lot more quickly than people expect, but not for great reasons. It'll be coming down because the economy is going to slow down. Of course, has implications for employment and stocks and a lot of other important matters.
There's a deep irony here, and what the book really does, as far as I can see, is it explains what's gone wrong for the policy environment here. When the inflation started, the central bankers were saying it's transitory, it won't last, we don't have to do anything about it, it's just a supply shock, and you've just explained that. The book explains why that supply shock and the inflation which is causing will persist for a bit longer than expected. And what's happened lately is that central bankers have said, oh, actually, it's not transitory, it will persist, we've got to hike interest rates, and they're panicking and hiking rates really quickly, just as the inflation is coming back down because the supply shock is not being felt as keenly anymore. And instead of dealing with the supply side of the economy, central bankers are pulling back demand just when they don't need to anymore. And that will lead to the financial crisis and the disinflation that you're anticipating. So I think the book explains how that mistake occurred, and the fact that supply chains take a lot longer to fix and to sort themselves out. And that's why the inflationary effect is transitory. It's just that it's a much longer transitory than anyone was expecting. You also, though, talk about the fact that there is a risk that as a result of supply chains triggering this inflationary spike, that inflation will persist over time as people do change their expectations and wages do move, and all of those classic demand side of things do come into play. Are you still worried about that?
It's still a risk. And that is what happened in the 1970s. I talked about 1973, 1974 as being a supply shock. Price of oil went up. You had to bear the cost, but that depressed other areas of the economy. We went into a very severe recession, and that's all true. But then you have to take into account the fiscal and monetary response, at least in the 70s in the United States. Of course, the dollar is, at the time, 70% of global reserves. To this day, it's still 60% of global reserves and a large percentage of payments, and almost 100% of payments in oil or natural gas are in dollars. So of course, the dollar is a big deal, not just for the U.S., but globally. But in that time period, 75, 76, bear in mind, we had a presidential election in 1976, but the Federal Reserve just accommodated the price pressure. They just printed money at the worst possible time. But again, it was partly politically driven. It operates with a lag. So that did feed into the demand side. And again, unions were a little stronger then than they are today. But even in non-union shops, I know I was just at the start of my career. And when that inflation really took off in 77, 78, and 79, then it was going up 9%, 10%, 11%. It peaked around almost 15%. It was well over 13%. I remember in 1981, you could have bought a 30-year U.S. Treasury bond that with a 15% coupon. Imagine buying that in 1981 and sitting back till 2011 or 2021, 30 years later, collecting 15% all the time. Well, you could have bought that bond at the time, but people were running away from it because they didn't know how high inflation was going to go. But that was a case where it started on the supply side and morphed into the demand side. So that's exactly what happened. But the bridge, if you will, the from supply side to demand side, what was that bridge, or what was that channel whereby that happened? The answer was it was accommodative monetary policy by Arthur Burns. And then we had a Fed chairman, G. William Miller, possibly the worst and least memorable Fed chairman in history, but Burns, much better known, more highly regarded, but he also blundered. But they just put the pedal to the metal in terms of money supply, and the result was predictable. Now, is that a possibility? Yes. But is it actually happening? It appears not to be the case, mainly because the Fed is taking a different approach. I mean, the history of the Fed since 1913 has been one long series of blunders, but they kind of at least know how to fight the last war, even if not the next one. And Jay Powell's looked at this and says, I don't want to be the Arthur Burns of my generation. I don't want to be that guy. And so we're going to snuff out inflation. It caught us by surprise. We have Jay Powell giving some testimony before Congress in November 2021. It's on the record. We have the video, and he says, I think it's time to retire the word transitory. So he admitted it, threw in the towel, says it's not transitory. Now he's determined to get rid of it. And the Fed started raising interest rates in March 2022. They've got them up to 4.5%. In still less than a year. It's only 10 months or a little over 10 months since they started. So to go from 0 to 4.5 in 10 months is extraordinary. That's not this is not the sky high numbers you heard about with Volcker in 1980, but in terms of from point A to point B, that is the steepest, fastest interest rate hike increase in the history of the Fed, including what Volcker did. Volcker went much higher, but it took him several years to do it. So, and Powell's made it clear in a series of speeches starting in August 26th, 2022 at Jackson Hole. I won't recite every day, but there have been 5 speeches since then, either press conferences following Fed announcements or speeches, one at the Brookings Institution, for example. And he said the same thing every time. Killing inflation is job one. That's what we are all about. That is our job. We know there's going to be a recession. We know unemployment is going to go up. We know there's going to be pain. He actually used the word pain, which is extraordinary for a Fed chair. But he's made it clear that they're not going to rest until inflation is back to their target, which is 2%. And it's nowhere near that right now. Coming down, yes, but not there yet, and a lot more work to do. And that's what they say. We have more work to do. The markets have kind of taken a very skeptical view of that. The markets, yeah, we all see the same data. You can analyze it differently, but we all see the same data. Everyone sees the inflation coming down. But the thing you have to sort out is inflation coming down because the Fed is hiking rates? In which case it suggests you should keep hiking rates until it gets to where you want. Or is inflation coming down because the Fed has hit something called the terminal rate? Sounds like a Arnold Schwarzenegger movie, but the terminal rate, no one knows what it is, by the way. I don't know, but neither does Jay Powell, and he admits it. But in theory, the terminal rate is a rate, a policy rate set by the central bank that's high enough so that if you leave it there, inflation comes down on its own without the need for further rate hikes. So inflation is coming down, no question. But is it because the Fed has continued to raise rates, or is it because the Fed has hit a terminal rate and all they have to do is nothing, just pause, as they put it, and inflation will come down where they want? The market believes we're at the terminal rate. The Fed should just stop right now, leave it alone. Sooner than later, pivot to, that's the new buzzword, pivot to rate cuts. And it's the anticipation of those rate cuts that has Wall Street all spun up, and they got the pom-poms out and saying, buy stocks, buy tech, because the Fed's going to cut rates. The Fed does not see it that way at all. The Fed says, yeah, we're raising rates, inflation's coming down, but we're not at the terminal rate. We'll kind of know when we see it, but they think it's probably 5.25. That's a very good estimate based on what the Fed has said themselves. I think that's what they think. You know, in this game, you can't do your analysis based on what you think, at least as the first approximation. You have to figure out what the other guy's thinking. It's like chess. Figure out what he's thinking, then do the analysis, and then add your own kind of top spin on that. So there's no doubt that the Fed thinks they've got to go to 5.25. Well, if we're at 4.5, you need 75 basis points of hikes. And it looks like, and we already know on February 1st, the Fed is going to raise interest rates 25 basis points. There was some debate about whether it was going to be 50 or 25. They have their channels. You have to know who their favored reporters are, but we do. And you follow those reporters. And if Jay Powell wants to leak something to the market, it's, this reporter, this publication. And when you see his name on the byline, it's coming straight from the Jay Powell. So the Fed has leaked the fact that the February 1st rate hike is going to be 25 basis points. Okay. So that gets you to 4.75. But take what I just said, if 5.25 is the target and you go 25 basis points, you need 2 more 25 basis points hikes to get to 5.25. And they will be on March 22nd, which is the meeting following the one coming up. And then finally, there'll be another meeting in May, and look for 25 basis points in May. We'll fine tune that. That's still pretty far off, but that would be the best estimate as of now. And that would get you to 5.25. At that point, the Fed might pause, not pivot, but pause, see to it that inflation comes down. Let's observe the data and watch it come down. Then when it gets to the target, then maybe wait a little bit longer. And then only then would they be ready to cut rates in their view. Now, the market thinks, sorry, Fed, you're already at the terminal rate. You're just the last to know. Inflation is coming down on its own. You don't need further rate hikes. Oh, by the way, you're destroying demand, pushing the economy into recession, unemployment's going to go up, et cetera. So the market says the Fed's going to get that memo very soon, meaning February or March. Maybe they'll raise rates in March, but they'll stop there, start the pause, and maybe pivot, meaning rate cut, as early as May. I don't see that at all. I understand the analysis, but to me, that's the market's, they call it the Goldilocks or the soft landing scenario, pick your name. But they're saying that the Fed will pivot before that much damage is done. When they do, they'll cut rates, and that's good for stocks. So buy stocks. That's the Wall Street mantra. My own view is a hybrid of the two. The Fed's on course to do exactly what I described. I do believe that they probably are at the terminal rate. They probably will do more damage, but bear in mind a couple of things. Monetary, I hate to use cliches, but some of them are true. Monetary policy acts with a lag. So the Fed has not seen yet the implications of the November 75 basis point hike and the December 50 basis point hike. That hasn't really fully kicked in yet. That's still playing out. And yet the Fed has kind of what they call recency bias. They're looking at inflation month by month. They don't see the progress yet, at least not that much. Well, it's coming, but they will have raised rates several more times before they kind of get the message that, yeah, they're already there. By then, the damage will be done. Unemployment will be up. We'll be in a recession, probably a severe one. And because now here's where it gets a little recursive. The Wall Street is bidding up stock prices. We're in a stock market rally right now. Wall Street's bidding up stock prices in anticipation of this soft landing, so-called. But meanwhile, the Fed is engineering a crash landing, which the Fed doesn't quite realize. And when those two converge, the stocks are just going to drop. They're going to have to reprice, meaning down 30% in a very short period of time, probably less than a month. And I would expect that to happen in kind of in the March, April timeframe. That's when the Fed will say the job's done, but the damage will have been done. The economy will be in a steep recession, maybe on the verge of a global liquidity crisis, and the market's going to be like the roadrunner or the coyote. Coyote runs off the cliff with a box of dynamite, is in midair, doesn't realize it, and then looks down and falls straight down. That'll be the stock market will be the coyote with the dynamite when they realize that the Fed has done a lot more harm than they expected.
It reminds me of a doctor treating the symptoms rather than the cause. So the symptom is inflation. So they're messing about with the demand curve with monetary policy. Meanwhile, it's actually the action in the supply chains that is determining the inflation and the disinflation. And of course, that's going to go badly in the end with the analogy that you specified. The reason we're focusing so much on this inflation and deflation debate is, well, 2022 sort of showed why we had unexpected inflation. It caused complete chaos, especially in the US markets, but also in the bond markets all around the world. So I think figuring out whether it's inflation, disinflation, or deflation is really important for your investment mix.